Hello, my name is Louis Pires, and I'm the president of TMI at ASU. In this video, we're going to be covering one of the most important financial concepts, being compound interest. Now, while this is one of the most important financial concepts, it's also one of the most widely misunderstood. In this video, we're going to be talking about standard market returns, which according to the Business Insider in August of 2020 is about 9.2% across the US stock market. So let's say you graduate from college. Doesn't matter what your major is, business, engineering, liberal arts, whatever. You graduate from college with about $10,000 in saved earnings, and you put that immediately towards your portfolio. Let's say you put that in the S&P 500. So you have $10,000 in your portfolio. Your new job that you just got hired for gives you $50,000 per year, and you decide to commit 20% of those annual earnings towards your portfolio, which equates to about, obviously, $10,000. Over the next 10 years, you continue to make $50,000 worth of income after tax and commit $10,000 worth of your annual income towards your portfolio, or the S&P 500 in this case. So let's draw that out. After 10 years, you're now 32 years old. And after investing a total amount of $110,000 in your portfolio, that account balance is worth $191,610.41. So the interest that you've earned, meaning money that you haven't had to work for in any way whatsoever, equates to $81,610.41, which is well over a year's worth of your income after tax at the job that you have at the time.
At this point in time, you're now 32 years old. The company decides to give you a big-time promotion from $50,000 a year all the way up to $100,000 per year. You continue to decide, hey, I'm going to contribute 20% of this every single year towards my investment account. Now you're contributing $20,000 a year towards your investment account. In total, you have contributed $310,000 to your investment account. And yet your total account balance is almost $800,000, meaning that you've accumulated over $405,000 in interest up to that point.
You are now 42 years old, and you have been promoted to a high-end managerial position in your company. At this point, you earn $200,000 per year, but you stay committed to investing 20% of your annual earnings to your portfolio. In this case, the general market, the S&P 500, at an annual return of 9.2%. After another 10 years, you are now 52 years old, and after contributing $40,000 per year for the past 10 years, your account balance is at $2.59 million. Keep in mind that your account balance just 10 years ago was $797,000. The contributions that you've made over the past 10 years is $400,000, while the total contributions that you've made throughout your career is $710,000. At this stage, at the age of 52 years old, you have earned just through interest, specifically in this case, compounded interest, $1.88 million.
So by this point in time, you're 52 years old and you're planning to retire in 13 years at the age of 65. So you continue investing 20% of your total earnings every single year into your investment portfolio until the age of 65. So that's a total contribution of $40,000 a year since you're earning $200,000 a year in total. So at the age of 65, you decide, finally, I've been working at this place for 43 years, fresh out of college. And your account balance is sitting at a very pretty $9,153,000. So how did it get that way? Well, in total, you've invested only $1.23 million over 40 years. That's the number that you had up to the last 30 years, and only $200,000 from the last 10 years. And your total interest earned is almost $8 million at $7.923 million. So your total earnings from the job that you were making, not accumulating for any of the money that you invested, were $4.88 million over those 40 years. But yet your total earnings were $14,033,000 over the course of the 40 years, including the money that you invested in your investment portfolio.
At the age of 65, after a 43-year career, it is time to sit back and relax with your family. Now let's look at the breakdown that was analyzed just before. You have earned a total of $14 million over the period of the past 43 years. 65% of your entire net worth can be attributed just to your investment portfolio. Now, why that's especially incredible is that you have to keep in mind that you've only been contributing 20% of your earnings over the past 43 years. And 20% of your earnings has resulted in 65% in everything that you're worth. As a matter of fact, 56.5% of all of your assets come entirely from the interest earned on the portfolio. So this doesn't include the money that you've been investing or your contributions. This is purely the interest that has been earned over the past 43 years, money that you've never had to lift a finger for, as it continues to grow at 9.2% per year with the market. Without investing any of your earnings, i.e., if you decided to save your money, if you decided to spend your money on Gucci bags and other needless products, you would have earned about $6.1 million. At this stage, you're sitting pretty with $14,033,000. This example goes to illustrate the importance of compound interest, and perhaps more importantly than just the idea of compounding your money is the notion that you should start as soon as possible. Putting away those $10,000 from your $50,000 income at the very beginning of your career is just as crucial as putting away the $40,000 once you're earning $200,000. Starting early allows for you to accumulate the compounding interest of the market. That is what builds wealth. Thank you.